Welcome to Skiller Learning. In this video, we will cover top 15 must-know financial analyst interview questions. Question 1. Let's say you're reviewing a company's financials. Which statement would you look at first to quickly check the company's profitability? The correct answer is income statement, as the income statement reflects revenues, expenses, and net income, giving a direct picture of profitability. Question 2. If you had to analyze how much cash a business is actually generating, which financial statement would you prioritize? The correct answer is cash flow statement, as the cash flow statement reveals the real inflows and outflows of cash, which is vital for liquidity analysis. Question 3. Suppose management asks you to evaluate the company's short-term financial health. Which ratio would you calculate first? The correct answer is current ratio, as the current ratio, current assets divided by current liabilities, indicates a company's ability to pay off short-term obligations. Question 4. Imagine you're analyzing a company with high revenue but very low net income. Which metric would you check first to understand why? The correct answer is gross margin, as a low gross margin could mean high costs of goods sold, explaining why revenue isn't translating into profit. Question 5. Let's say a firm is expanding rapidly but you notice its debt levels are also climbing. Which ratio will you calculate to assess financial risk? The correct answer is debt-to-equity ratio, as the debt-to-equity ratio shows leverage and risk. High ratios indicate more debt compared to equity. Question 6. If you want to evaluate how efficiently a company is using its assets to generate profit, which ratio should you look at? The correct answer is return on assets, ROA, as ROA equals net income divided by total assets. It shows how well a company utilizes assets to produce earnings. Question 7. Suppose you're comparing two companies in the same industry. Which valuation ratio would help you judge their market value relative to earnings? The correct answer is P/E ratio, as price-to-earnings ratio helps compare companies' valuations relative to their profits. Question 8. Imagine management asks you whether a project is worth investing in. Which method would you use first to evaluate its financial viability? The correct answer is net present value, NPV, as NPV helps determine the value of future cash flows compared to the investment cost. Question 9. If you notice a company is profitable but still running into cash shortages, what's the likely cause? The correct answer is high receivables or inventory, as profitability doesn't equal liquidity. Cash can be tied up in receivables or inventory. Question 10. Suppose you're evaluating a company's risk of bankruptcy. Which financial metric would be most useful? The correct answer is Z-score model, as Altman's Z-score predicts bankruptcy risk based on multiple financial ratios. Question 11. If you're tasked with building a company valuation model, which method would you likely choose for startups with unpredictable cash flows? The correct answer is comparable company analysis. As for startups, comps are more reliable than DCF since cash flows are uncertain. Question 12. Imagine the CEO wants to know how much profit is left after paying interest and taxes. Which metric would you report? The correct answer is net income, as net income is the final profit after interest, taxes, and all expenses. Question 13. You're reviewing a company's working capital. What does negative working capital usually suggest? The correct answer is financial instability, as negative working capital means current liabilities exceed current assets, which can be risky. Question 14. Let's say you're analyzing two bonds. One has higher yield but lower credit rating. What does that tell you? The correct answer is higher risk, higher return. As lower credit rating means more risk, so investors demand higher yields. Question 15. Suppose your manager asks you to calculate free cash flow. Which formula will you use? The correct answer is net income plus depreciation, working capital, CAPEX. As free cash flow equals cash available after accounting for operations and capital expenditure.